There's a bit of complacency that's out there. I think the GDP numbers probably look a little bit weaker in the fourth quarter and the first quarter of next year, based on, my reading of the data. And, I don't really see much evidence that the labor markets are turning around. So, even with the Trump win, right? It's, you ask a business, do you feel better? Sure. Well, what are you doing? It's sort of, well, we're waiting to see what they do.
Welcome to RenMac Off Script, where we can discuss markets, economics, policy, history, and life. It's the 15th of November, 2024, and I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Pavlik.
We're going to touch on, obviously, these nominees. We're going to touch on inflation and Powell. Hit a little bit on Bitcoin, what's going on in terms of the S&P now at 6,000, and what's happening in addition to these things in Washington. But let's go to Neil. And the only reason, Steve, I'm not giving you the stiff arm here is because I'm just exhausted from politics. So we're gonna jump to Neil first. But Neil Dutta, we had inflation data out this last week. Now, you know that our market cycle clock moved a little bit higher at the beginning of the month, and that was really due to inflation. Some of those inputs that just said we're not in that deflationary zone that is really good for equities. This is kind of a middling zone, roughly 450 basis points or so on an annualized basis. Certainly still in an uptrend for stocks. But what did the latest inflationary data tell us? And what is that impact going to be on the Fed and the Fed's thinking?
Well, the latest inflation data, we're kind of a step in the wrong direction. It looks like core PC inflation is going to be around 0.3% for October. So that would be the second month in a row of a relatively firm print. And I think that kind of leads to a natural kind of reluctance to continue easing monetary policy. And you kind of saw some of that with Powell's comments this week when he talked about that, we're not in a hurry, kind of breathing life into the idea that they might skip December. Certainly they'll be skipping meetings in 2025. And I think by the time the December meeting rolls around, you'll probably, when they do that meeting, you're going to see them erase some of the cuts that they have baked into the 2025 outlook, which I think makes sense, because the economy has been holding up somewhat better than expected. Now, that being said, I do think that they are kind of, in my opinion, kind of complacent on conditions, right now. If you take a look at some of the things that Powell was talking about yesterday, for example, he talks about, he put it a slow but cooling, a solid but cooling labor market, right? Now obviously that's kind of trying to have it both ways, right? If things keep cooling, they'll no longer be solid. If you look at quits rates, they've actually hit cycle lows, and compensation growth has been following pretty predictably. So I think it's a stretch to think that wages will keep up where they've been. They've already been slowing. I think that probably continues. He talked about business investment being strong or accelerating over the past year. That's true, but at the same time, you're seeing fading support from non-residential manufacturing structures. A lot of that is kind of pinned on the CHIPS Act and so forth. But and also Boeing's been weaker. So I think some areas of support for business investment look like they're fading also. And then he talks about consumer spending having been strong, supported by real disposable income and strong balance sheets. But if you actually look at incomes excluding transfers, they're up just 1% over a period where consumer spending has been growing almost 4%. So something has to give there. You can't have strong consumer spending if incomes are continuing to slow. So it's not a sustainable situation. So I think there's a bit of complacency that's out there. I think the GDP numbers probably look a little bit weaker in the fourth quarter and the first quarter of next year, based on my reading of the data. And I don't really see much evidence that the labor markets are turning around. So, even with the Trump win, right? You ask a business, do you feel better? Sure. Well, what are you doing? It's sort of, well, we're waiting to see what they do.
Right.
Well, if that's the case, then, I mean, everything's not kind of still frozen. So I just, and obviously he did mention the weak housing market, but, I just say that there's a bit of a complacency here. And I think that the data has some scope to surprise on the downside, over the next couple of months.
Uh, you posted a chart of the NFIB. I think it was small businesses responded saying poor sales are, kind of their primary concern, and that's the highest level since 2021. How important is that to you? Is it meaningful enough right here to be a problem or a prelude to a bigger problem? What do you think about?
I just think it's a continuation of a problem. I mean, the reason I posted that chart is because of its strong contemporaneous relationship with the unemployment rate. And so, we'll see I mean, obviously a lot of the sentiment data can shift because of the election. We saw that last time, right? As an example, small business sentiment was a lot stronger when George W. Bush was president than it was when Bill Clinton was president, even though the economy was growing much more rapidly when Bill Clinton was president than when W. Bush was president. So I think it pays to keep that in the back of your mind, but there is interesting kind of nuggets of information under the surface. And the fact that small firms are complaining more about their sales tells you a little bit about the direction of travel, I think. And in my mind, it just means that there's still a risk for the unemployment rate to continue going up. Yes, initial layoffs are low, but those newly laid off people are having increasing difficulty finding work, which is why the duration of unemployment is still going up. So, I don't think we're out of the woods yet. And certainly labor demand continues to cool. We're not really seeing much in terms of stronger labor demand out of the sort of high frequency like job openings data. I mean, I wouldn't say the economy is falling off a cliff, but I would probably tend to lean against the idea of like this growth optimism that you see that's kind of out there right now.
So in your book, between now and year end, one cut?
I mean, there's only one meeting between
Oh
now and
yeah, you're right. Sorry. Right.
Um, but yeah, I think they'll cut in December. I still believe that because I
But
think
so do
I
you think the skips, right? Getting back to that, if we kind of extend that out for the next 6 months, they're not cutting every meeting in your view at this point.
no, but I didn't think that they were going to anyway, and that wasn't embedded in their interest rate projections either. I mean, the last I checked, I think the futures market has them cutting three times in 2025. I think the current dots are at four, so they probably move closer to the market. At the December meeting.
So in the prediction markets, Trump overtook Harris on the 6th of October. It was almost perfectly the point at which the dollar turned around from an oversold condition and rallied. Very close to kind of this surge that we saw in the 10-year yield coming from, basically 380, and it was a payroll number, but from 380 to 4%. Is that the Trump trade as you see it? The stronger dollar, the higher rates, the firming of equities, right? Usually those things work against cyclicality. They're not here. So, there's a bit of kind of a historical precedent that we have, which is those events, higher yield, stronger dollar, should impact cyclicality, right? As the value of your exports becomes more dear to foreign buyers. Is this, in your mind, just a reflection of that Trump trade and the market having discounted the expectations of that win, or is there something else behind that?
Well, I mean, I certainly would agree that there has been a Trump trade put on. I don't know it's a trade that you want to own. Maybe it's a trade that you want to rent. My friend Luke Kawa called it, these are Trump trades, not Trump investments. And I thought that was a pretty good way of putting it. I mean, if you look at the small cap, the Russell, I mean, as you know, I mean, that's actually, I think, somewhat lower than it was at the close the day after the election. So, some of this has been quite fleeting. I would just say, I mean, we wrote a note to clients this week basically saying that, this is not 2017. I think that's worth just reminding people. I mean, it's not as clear cut today as it was then. In some respects, I think uh, the incoming administration is hamstrung somewhat because of where interest rates are. And, in other words, Biden went to the fiscal well a little bit too often. And that's kind of limited the options for the incoming team. So, if they want to free up money for tax cuts or extending TCJA, they have to find things to cancel. One of the things that they could do, obviously, is basically brand, the IRA and the CHIPS Act as sort of like the new Obamacare. We're going to repeal it and replace it with something better. But you have to, I mean, things like green energy subsidies, like maybe there are things they can do unilaterally, like the loan programs. Um, that's on the fiscal side. So I do think there's a little bit too much fiscal impulse baked into the back end of the Treasury market. And then if you look at the economy, nominal growth is cooling, right? Nominal GDP has basically been below 5% for most of the last year. And during that time, you've seen interest rates kind of back up. So I think that's kind of interesting. But I would just say that nominal growth is still slowing down. And that's kind of where I'm at. So you have weaker labor market. You have some of the impulse from, to CapEx kind of fading, as I mentioned. The housing market's still a mess. There's really not much evidence that housing is improving. So this is a economy, he inherits an economy. I wouldn't call it weak. I would call it out of balance, right? I mean, this is not a balanced economy. And I would definitely argue that, the unemployment rate, yes, it's low, but that kind of overstates the degree of health in the jobs market when you look at things like the rate of job growth, like quits rates, like hiring rates. So
Yeah, private sector versus public sector too is a little out of kilter, you might say. All right, speaking of people bucking for jobs here, Mr. Pavlik, we've got what do we call them? Appointees, nominees
Nominees.
in waiting. Well, how does that what's the nomenclature in your town?
Well, I think nominees is probably safest right now.
All right. So we've got a handful of them. We don't need to go through each and every one, but let's talk a little bit quickly for those that aren't up to speed in how things work in Washington, what this process looks like, and then let's get into, who's the most controversial, who you don't think is going to be able to make the cut, and why.
Well, sure. I mean, so the president and their transition team sort of worked through to identify candidates. At this point, we're sort of seeing the intent to nominate come through for some. And for a lot of these positions, particularly for cabinet agency heads and those that are going to oversee agencies, they require Senate confirmation. Whereas a lot of the White House roles, all of the White House roles, do not require Senate confirmation. So that's an important distinction. So what does it actually mean? So we get to January 20th, it's inauguration day. That's when the new administration will officially take over. They will send the letter to the Senate officially nominating people. That will kick off the process. At that point, the nominees will be sent to, in terms of their candidacy, to the respective committee or committees of jurisdiction. Sometimes it's more than one. They'll do an initial investigation, and then they will usually decide to proceed with some hearings. Familiar with all these confirmation hearings. For investors, it's a good idea because they're going to press a lot on their policies. To maybe glean some insight there where they're likely to head in terms of the policy direction. And at that point, assuming they make it out of committee, then the full Senate will vote on them. The vote threshold has changed, going back to something that then Senate Majority Leader Harry Reid, Democrat from Nevada, did. So now it just requires a bare majority, which is 51 Senate seats. And right now it looks like Senate Republicans will have 53, and they can afford to lose 3 because Vice President J.D. Vance can be the tie-breaking vote there. So that's in essence how it works.
And as we look at that, who are the likely impediments to moving forward? And are they the same for every candidate? I mean, kind of feels like these people traffic around the obstructionist role, but how does that play out?
Well, I think one thing that's different this time, Neil was talking a lot about between Trump this time versus last time. I know he's referring to the economy. On the transition front, he's had 4 years to think about, what he wants to put into place. And he also had experience this time where he didn't the last time in the role. And so I don't think it should be a surprise that we're seeing quick pace with respect to the names of people coming out. I think we also seen sort of a thematic approach similar to last time with the initial sort of tranche on national security and foreign policy. I think there's some question whether I can pivot to the econ name. It seems now we may be at the domestic agency names, some of the names we just got, yesterday. So I think that's sort of what moving forward. But in terms of, you think about the success rate of getting nominees through this modern era, even when your party controls all the levers, I can't remember a time when every single nominee makes it through. And so sometimes you give the Senate some targets to shoot at. So, that way they're sort of to focus their attention on a few areas, claim a few scalps, or may make it easier to get some of your relatively marginal candidates maybe through a little easier. So the other thing to keep in mind too is, Trump likes surprises. He's an entertainer by heart, but I think he also likes to remind people, one, that he's in charge, and two, if you sort of think about some of these controversial things with respect to Matt Gaetz for Attorney General, Robert F. Kennedy Jr. to lead the Department of Health and Human Services, or even Tulsi Gabbard to be the Director of National Intelligence. All three of those people have felt wronged by the respective agencies they may have been nominated to lead. And I think that's something that really resonates with Trump. Whether or not they can make it through confirmation it remains to be seen. I'm a little skeptical, particularly of Matt Gaetz for Attorney General. But we'll see what happens. It's going to be difficult for Republicans, given Trump just won the popular vote politically, to push back on him on a lot of these nominees. And keep in mind too, well, the Senate majority is basically the same. I think Trump and Republicans have 52 Senate seats in 2017 versus now it looks like 53. The percentage of Senate Republicans that aren't aligned with Trump is much smaller and relatively stronger. Even with Senate Majority Leader incoming John Thune, who's sort of viewed as somebody more in the McConnell role. If you look at the number 2 and 3 ranking Senate Republicans, John Barrasso from Wyoming, number 2 whip, and then Senator Tom Cotton, number 3 there, I guess, conference chair, they're much more aligned with Donald Trump. And my guess is they'll sort of act as a check there on Thune. They fear that he's veering too far off course.
Is there anyone coming back from the previous administration, or is this a whole clean slate? Particularly at the top, I'm sure there'll be some, deputies, et cetera, that are returning. But is there anybody either being promoted? Hey, you did a great job as number 2 or number 3. We're going to put you into the lead role. Or is there anybody who was in the seat that they're bringing back?
It depends on the role. You've seen some folks come back to the White House that were there the last time. I think some of the White House aides, Dan Scavino, Stephen Miller, Tom Homan is going to be the border czar, which doesn't require Senate confirmation. He's somebody that ran the ICE program last time in terms of their immigration enforcement. So that to me sort of suggests that maybe they were going to see more centralized power compared to last time when a lot of the authority was delegated to the agency heads and cabinet secretaries, because it's been discussed that former USTR Bob Lighthizer might come back in the trade czar role, which would sort of support that theory. And if that means that Lighthizer wouldn't have to wait for Senate confirmation, he could step into that role right away. It's been discussed him having actually a tariff oversight over both USTR and Commerce, which means we could see some of these tariffs potentially take place sooner in the year as opposed to more of a mid-year event. So that's something to keep in mind too. Some speculation where they'll be phased, different targets at different times. But I think that's something to keep an eye on as well. I believe it's
a quick question about the czar role though. Does the czar role make the official role then just kind of a figurehead role? I mean, isn't that, if you don't need appointment, aren't you just kind of saying, we'll appoint you, but you're not really, you look pretty, keep that tie, that half Windsor tight and look good. But this guy's really running the show.
Look, at the end of the day, everybody reports to the president. And so it's really what's understood between the relationship between the czar, the cabinet secretary, where they may have some overlap there with the president. The cabinet secretary is going to actually have the official jurisdiction over the agency, but it's understood, to your point, that they're more or less reporting to the czar, who's sitting literally closer to the president. That's something to keep in mind on where you're trying to figure out who's actually in charge here.
Yeah. Go ahead, Neil. I know you were chomping.
Well, I wanted to just talk a little bit about the tariffs, the timing of the tariffs. Again, this is sort of not like 2017, right? Like, so people trying to dust off the playbook from the last administration, the last time that Trump was in office, they need to maybe create a new playbook. Remember, back then it was really about the sequencing. He was the market's best friend in 2017 because all the impetus was around tax cuts, deregulation, things that the markets would love. By contrast, and then he pivoted to tariffs, right? I mean, if you remember back then, he said, I'm playing with the house money. So in other words, you do something to fatten up the margins of the corporate sector, and then you use that to go prosecute the trade war. The other thing that's different is that the Fed is not in as forgiving a mood this time around because we're coming off of a period of very high inflation. Okay, in 2017 and 2018, when the tariffs started, we were coming off a period of very low inflation. So there wasn't really much of a knock-on effect, I don't think, to inflation expectations as there was back then. So this is important to keep in mind, right? The Fed's not going to be as forgiving, I don't think, this time as they were last time. Again, another way in which the Biden, agenda has hamstrung them to some extent, because one of the reasons why inflation was so high in the first place, and this is, from studies from the San Francisco Fed, is because of the large fiscal impulse, in the period after COVID, like things like the American Rescue Plan and so forth. So that obviously contributed to the rise in inflation, and the prolonged period that the country was dealing with high inflation led to an increase in inflation expectations. And so the Fed is going to be more cognizant of that now than they were last time. I mean, last time they kind of looked through it. This time, there's a risk they don't. And if to the extent, tariffs are a tax hike, okay, that's what that is. And so all else equal, it will slow the economy down, right? And if you layer on the fact that there may be an upward push in inflation expectations as a result of that, well, then you won't have the Fed really offsetting it. So it's a double whammy. Again, as I say, I mean, I'm surprised. I mean, one of the things I'm surprised by is that there hasn't been more of a concerted pushback effort on the part of the Trump team to push back against the idea that the economy is like great. They should actually be, I mean, because if you recall, it's kind of interesting. I mean, I remember back in 2021 or late 2020, as the Biden people were kind of assuming office, they set the bar so low, right? I mean, like we were doing such a bad job with virus suppression. We're the sort of sick man of the world. Of course, all of that was a bunch of nonsense. I mean, the American economy was basically on having a V-shaped recovery effectively.
Right.
And we were not the laggard of the world. We were leading the world. And he also inherited an economy with strong momentum, with 1 million jabs in the arms a day. Okay, right? I don't think Trump is inheriting as good a situation as Biden did, frankly, 4 years ago. Just trying to, just looking at it objectively. The level of the economy is good. There are things under the surface that don't look as good. And on the inflation side, because we're coming off a period of high inflation expectations and elevated inflation, he may not get the sort of recalibration from the Fed that he may have thought he would have gotten with tariffs, right?
So
remember, right? Tariffs were thrown on in 2018, and basically the Fed came in and offset some of that.
Right. So, Steve, a big part of the of pushing inflation down, at least from the campaign trail, was drill, baby, drill. Right. How quickly can you realistically start to produce, more oil in a sustained way that's going to lower that? I mean, look, you get oil back to $50, and that's going to have a huge impact on inflation, right? Just as that pig goes through the python. I mean, that's just the way it works. Realistically, what's kind of the lag between in office and getting some of these mandates through.
Well, look, I mean, to be honest, it's a lot easier to shut down oil immediately when you cancel a pipeline or you sort of just inevitably delay these permitting things. It's much easier and quicker to stop it than it is to accelerate it. That said, clearly accelerating fossil fuel production, because I think there may be more opportunity for LNG, honestly, than oil. Because one of the things, Neil talks about the tariffs and maybe what's different this time versus last time is, remember, last time Trump was running for re-election. This time he's not. So this idea that China could do this soybean solution, to sort of placate Trump, help him politically in a lot of Midwestern states with ag purchases, I don't think that's going to work this time. So what's the option? Well, maybe it's going to be able to export some LNG. It seems like the Europeans are already sort of welcoming this idea to try to, soften Trump's potential tariff wrath there. So maybe that's sort of a way to try to, incentivize these fossil fuel firms if they're concerned about what the U.S. demand is going to be. And that's also a way for, I guess, other countries to sort of, look for ways to reach a resolution here and avoid the tariff. So I think that may be more the opportunity personally. But yeah, there's certain things you can do. I mean, you can go ahead and start trying to reassemble those pipelines. You can go ahead and allow drilling on public lands, and obviously allow LNG exports. To me, those just seems like logical things to do. And then there's going to be a question for oil firms. I mean, there's been a lot of shareholder discipline that comes in, but maybe they want to do some things that may not necessarily be in the short-term interest to try to help a new president succeed. That may be more favorable to the longer-term outlook. I don't know, but I do think with respect to other areas like artificial intelligence in particular, we're only going to need more energy. And to your point, I think that's a big part of the Trump administration's plan to keep inflation low, is to really rely on lower energy costs to sort of offset some of their growth intentions.
Well, I mean, it's a classic Trump trade, right? It's simple, it's logical, I mean, it just makes sense. I mean, I know it breaks some eggs. There's no doubt about it, right? But if your objective is to have reliable power, right, as your priority, then that's the right call. You've got to take advantage of what you've got versus these very complicated and the process of getting through with the environmental side and everything else, and then frankly technology that doesn't really work yet, right? At least not to scale in the way that needs to be done. So we'll see how that plays out. Well, what I would say for the markets overall, I mean, look, we hit 6,000, so a little milestone there on the S&P. We're doing it from an overbought condition now, so the percentage of issues that are overbought did trigger in our work earlier this week. That usually results in a consolidation, not a big correction. We do still have good, solid trends in place. No momentum. We're not in a momentum market, and we've been talking about that for a while. And again, that's 2 steps forward, 1 step back type of situation or market where you can be patient. You don't have to chase things, and that's how we're looking at it here. I do think still that cyclicality is the right call between now and at least the inauguration. We are seeing some of that in financials. Financials aren't traditionally cyclicals, but certainly they are leadership. And in this cycle, they seem to be falling more in line with those cyclicals. At the same time, we don't like semiconductors. And I'll be the first one to say that those two statements do not jibe. You need cyclicals, and if you like cyclicals, you're going to like semiconductors historically. So there's there's a discontinuity there that we recognize. We'll see what happens or how it plays itself out. But what we'd like to see are semiconductors start to improve to really ratify the cyclical strength. What we wouldn't want to see are cyclicals deteriorating and matching semiconductors. If that happens with banks falling under pressure, with credit spreads rising, or with real yields pumping up above 2%, that would be a problem. So those are things that we're going to watch. But between now and again, that inauguration, we still think that cyclicals are the right trade. And then where would we be if we didn't talk about Bitcoin? Obviously, a huge breakout there through 74,000 up to 90. We talked about 90 being the objective on the breakout. We got there. And we got there a lot quicker than even we expected. But what that's done is it has created momentum. And when you get momentum in Bitcoin out of a consolidation, which we've been in for the last 6 months, there are usually higher prices ahead. So, like that chart a lot. I think if you stuck your thumb over the name and put Nvidia next to it instead of Bitcoin, everybody'd want to buy it because they've got confidence in that narrative. But just from the charts perspective, it certainly looks really, really bullish to us. One thing that we're going to start doing, if you have questions, email questions@renmac.com. And hopefully, if it's a good question and sparks some debate, we'll address it here in the week to come. So that's questions@renmac.com. Neil, what are you watching next week?
Well, next week we have a lot of housing data. And remember, the housing market has been quite sluggish. We'll get data on housing starts and permits. We're going to get data on existing home sales as well. We'll also get the early look at the November PMI. So I'm curious to see how that looks because, again, I mean, in 2016, 2017, Trump was coming in at a time of synchronized global manufacturing upturn. We don't really have that going on today. Germany is a mess. If you look at factory production in Germany, it's actually lower today than it was, my gosh, like 6, 7 years ago. China, again, I mean, they have a growing trade surplus, which means that a lot of their whatever enthusiasm there's been around China, not a lot of that is leaking abroad. So, and then in the US, again, I mean, we just saw this morning, manufacturing production down again. Now, a lot of that is Boeing, but, when you take a step back, I mean, there just hasn't really been much in manufacturing over the last couple of years. It's basically been moving sideways. So, I think that's a concern. So the manufacturing PMIs will be something we'll be keeping an eye on. And in terms of Fed speak, it's pretty light, thank God.
Well, I can say thank God the election's over, but we'll go up to Pavlik. What's next week for you, Steve?
Next week, I'm sort of waiting to hear if we get any details from this meeting at Mar-a-Lago between Speaker Johnson and President-elect Trump. Apparently, Johnson flew back to Florida with him. That's important because it's really going to set the tone for the lame duck agenda. And I think whether or not Republicans are going to want to try to do some spending bills to get through the fiscal year, which would be September 30th, whether they want to continue resolution till then, the idea of doing one till March, which Johnson initially suggested. You can see a case for the Trump administration not wanting to deal with the government funding fight. They're right into the middle there, sort of 100 days there. But I think we'll get some clarity there. And sort of related to that, whether or not they'll try to do the debt limit during the lame duck. Remember that the debt limit suspension will expire on January 1st. Happy New Year, everybody. I think the actual threat of default's not until June because of extraordinary measures and revenues. But there's a good political case to try to address that during the lame duck as well, as opposed to right off the bat there for a new administration and a Republican Congress. So that's sort of what I'm keeping an eye on.
And as you handicap it, who doesn't make it through the confirmations?
I'd be surprised if Gates made it through. I think RFK Jr. would probably be the ones announced so far, the one behind him if I'm ranking them, and then I guess Gabbard behind that. My guess is the others at this point are probably relatively safe.
Are they sacrificial lambs? Is he doing it on purpose to give the Senate some red meat and show that he didn't, completely win?
There's some speculation with respect to Gates and the timing of investigation, some of his practices, for lack of a better term, in the House that was supposed to be released, I believe, today, Friday. And it's interesting because Gates is the only one that's resigned of the House members that Trump has plucked. And some believe that may have been intentional because technically the House isn't supposed to release investigations of people who are no longer members. So people can draw their own conclusions there.
Practices, yeah. Let's hope not too much practice. Well, we're going to be watching cyclicality, and frankly, semis. Those two things. Again, there is that divergence taking place that should come together. So that'll be important. Continue to watch the relative performance of financials and the performance of triple B spreads in terms of the longevity of this overall rally. 10-year yield right up against resistance. 450 on the 10-year is the resistance level. S&P really no resistance overhead because we're at a new high. S&P support down at 5696. We can call it 5700 as a nice round number. But any type of weakness, particularly given the seasonality this time of year, should be contained by those support levels. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter or renmacaccess.com for other updates. And until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Ballard.
We'll see you.